for a really great future. We're talking real money.
It may be summer, but we, the two of us, are here for you, the thousands of you, to help you muddle through your monetary life. Hello, everybody. I'm Don McDonald, not on vacation, along with Tom Cock on vacation, but taking a vacation break to work.
That's well put.
From almost Lake Chelan. Yeah, apparently, what did you do down by the lake to get moved back to the upper reaches of the valley?
You and we're about equidistant, I think, from Lake Chelan, actually. Yeah. We both can see it, but that's about it.
I can see it through your window.
Yeah, right it's there. Way down there. I'm not sure. Somebody else handles all this for me, as you know. I just
Of course, you have people.
So he has people.
Yeah, people who do things to
be at this address
people
this day.
Who help people are the luckiest people in the world.
Exactly.
Hi, everybody. This is a money show. And today we want to talk with you at 855-935-TALK. We always want to do that. 855-935-8255. So call us anytime in the next hour and 50 minutes or so. We'll talk money. But we also want to share things that we run into along the way. And Tom is a subscriber to the Puget Sound Business Journal, which is part of a group of business journals around the country that I don't subscribe to. I'm not going to tell you why. I
used to publish one of these.
You did use the one in Bremerton,
I enjoy it,
wasn't it?
No, it would be Bellingham, but that's close
Bellingham.
enough.
I knew something started with a B.
You were right about that.
I knew it was a B word. I knew it wasn't Bellevue.
There you go. I read it pretty religiously because I think the stories are good. I think the information is important, and I like to know about who else is doing what in business. I find it fascinating. So, yes, I do.
So you saw this thing that came through your email.
Yep.
And you sent it to me, and I read the headline, and it sounds like something that I'm just going to love. I'm going to love this. The title is Breaking the Golden Handcuffs, What to Do If Your Money is Trapped in an Annuity.
Yeah, I love this.
This is going to be great.
I love it. They walk through the promises of the annuity, protection, predictability, peace of mind, and then they talk about the reality, the lockup periods, the hidden fees, the surrenders, the lack of upside. That's how they arrive at the golden handcuffs, which is, I've heard that before, but not very often.
It's the surrender fee.
Exactly. Yeah. You're locked in.
We always slam the surrender fee. So I'm reading along. I'm going, hey, okay, I agree with all this stuff. I'm totally agreeing with all of this. And then they go to the alternate path, Tom.
They tell you how to transition out of this annuity. By the way, I'll give away. You mentioned the surrender. They will pay your surrender fee if you move the money to their product, which is it promises the following: 12% annual rate of return, 20% equity participation, tax-free distributions, and no volatility. I don't think it'd be a stock market if this is true.
Absolutely
just give your money.
Safe 12% income.
Yep.
With a kicker, an equity kicker, tax-free distributions. Well, they do. If you read the fine print later, they go on to say return of capital is free of.
Oh, okay. You get your money back for nothing.
You get your money back. That's the part. That's the part that's. You got to read the fine print. But what they're selling, it's a company called FISYN. And did I spend some time on this.
Did you ever?
Holy cow. I found out that the guy behind it, guy who wrote this article, which is really an advertisement, Ronnie McVaney, when you look him up on BrokerCheck, he used to be a broker, and he's got big disclosures where he's been sued. The most recent one for like $1 million in misrepresenting securities.
Okay, but you haven't even cut to the chase of what they're offering you, the actual investment, the thing that your money goes into that is so safe, so predictable, and will pay you regularly, tax-free.
Right. I don't know how it does that. Oh, and by the way, no leverage. Yeah.
Oh, no, we wouldn't borrow money. That would be crazy.
So they give you a 12% return on, what's the investment, Tom?
I still can't even believe this, but I think it's true. It's raw land in Texas. In Texas.
Raw land.
In Texas. Yes.
Now, to me, this had a familiar ring to me when I read all about this. And I went through there, and I thought back to, you remember Jordan Goodman?
Of course.
And Woodbridge?
Oh, yeah.
the mortgage deal that was supposed to provide you with, and they only claimed 6 to 8% returns with Woodbridge on mortgages, and we questioned that. We were going, how can they do this? Well, it turned out to be a Ponzi scheme. Now, what about this one? Stick around.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Frying pan into the fire. That's what we're talking about here on Talking Real Money. Leaping right from that hot frying pan into that burning fire by letting this guy from FISYN buy you out of your annuity so that you can take all the money and put it into his raw land partnership with Texas Land that he is telling you will return 12% or more.
Yeah, and you get the little kicker of the equity part there. That's pretty exciting too. You get that shot.
Oh, and I forgot, if you get in now,
guess
you can get a bonus of shares between 2 and 10%, a bonus. And if you get to that 10% level, he'll also fly you and your loved one to Fort Worth, Texas, coach, rent you a car, and give you 2 nights in a nice hotel.
That's not on my list, but okay. Okay, all kidding aside.
And it's got a great view of the stockyards.
Don't even get going on the smell. Just the view is enough. So this is FISYN,
FISYN. Yeah.
And this is their method of raising money, right? These are going to move money out of these annuities into their raw land deal. I can't blame them for doing it, but I kind of gotta. Okay, but I got to blame for sure the American City business journals for taking this as an advertisement, because
and they take it not just as an advertisement. It reads like a news column.
Yeah, exactly.
With only tiny type at the top that says "Sponsored content by FISYN."
Yeah, it's egregious in that method. Beyond the fact that I really love to come back in 10 years to see how many of these have lived up to the 12%, the 20% equity kick.
Let me give you my best guess.
Yes, how long?
I'm thinking. I honestly believe, and I could be wrong. This is my belief, solely mine. It sort of smells like a stockyard with like, you know, those corpse flowers that bloom like every several years and smell like dead animals.
You know what? Yeah. Mm-hmm.
Yeah, it's kind of that smell that I'm getting from this. It's a financial sort of smell. It smells like rotten money too. Yeah. And I'm getting real serious Ponzi vibes from this.
All right. Well, we'll see. We'll play it out. But this is, by the way, we agree with everything they said about the annuities. We do not agree with the solution. We'll just put that out there. In case it's not clear enough.
Let me add one other little fact that we alluded to. Okay. Actual Texas raw land partnerships.
God, I don't want to see the track record.
Scenarios. After you've been in them for 5 to 12 years, might give you an annualized return if they were really good land pickers of 8 to 10% per year. But that's at the end. There's no income because raw land makes no revenue. Well, unless you have cattle on it, but you're not going to put very many cattle on Texas property. And it costs money. Property taxes, maintenance. There's
I was
costs.
waiting for the oil mention in here.
Well, and if it's oil, you're not going to sell it for a storage unit later.
That's true enough. So, yeah, this is troubling at several levels. Not only the offering, as you said, not only the misleading aspect of that, but I think the fact that it appears as a feature in a major American city publication. I'll put it that way.
But we see this all the time. We see this with Kiplinger regularly.
Yep.
We see this with Money Magazine. We see this with Entrepreneur Magazine. We see this with CBSNews.com. They all take these stories that are paid stories and are trying to sell you something that in every case I've read, I believe are bad for you. Yeah. Every single time.
And they're pay to play. I mean, this is scary that this is what people are reading and believing they're getting editorial. I think that would be true.
So what's the answer for you? Be really skeptical of everything.
Don't believe literally everything you hear, everything you read,
everything.
Yeah.
All the texts you get, all of it. Just be skeptical of all of it. You can't. Honest to God, the crooks are so numerous that you have to assume now everybody is one. You do,
and then work from the other direction instead of.
Yeah. 855-935-TALK is our phone number. That's 855-935-8255. And our first stop today is down in Texas, in Houston. Robert, welcome to Talking Real Money. Turn the radio off.
Hello.
Computer.
Hey, how are you?
Robert.
I'm doing wonderful. It's an honor to talk to both of you gentlemen today. I've got a question about long-term care. My wife and I are 62. We are we're behind on where we think we should be, but we're debt-free and stacking it up till we retire. We got about $700 portfolio, and we want to have some kind of long-term care protection. We talked to an advisor, and we were looking at the traditional insurance, which is very expensive, and you pay it for the rest of your life until you die. And he offered us a fixed annuity with a long-term care rider. And basically, it's if we give them $100,000, the long-term care benefit is $300,000. And we're just confused by the product when we look at it. And I know we just started listening to you guys earlier this year. We love what we're learning. And I just wanted your take on that.
Well, we're disappointed you didn't call about the raw land deal because it's right down the road from you there in Houston. We thought you'd be all over that.
No, it's up the road. It's up in Fort Worth.
Up the road down there. My
yeah.
geograph, not that good.
Yeah, and it's Texas. It's a flippin' big state.
I'm kidding. No, we're not pitching raw land, nor do we suggest it. But what you're talking about here is an insurance product that is going to provide, yes, if needed, that long-term care as a part of it. And there's no easy answer here because the right solution is going to be tricky.
Here's how it works. There's no magic in this thing, and the devil really, truly is in the details. My guess is that it's going to pay out a very small daily benefit, and you're maxed out, as you know, at $300,000. So
you're correct. That's one thing I did look into it. It has a monthly max benefit, but that actually turns into a daily benefit. So if you don't use it 3 days of the month, you lose proportionally that amount. And it turns out, depends on how much you put down, but you're right. It does limit the amount of benefit you can get.
Let me ask another question, though. Sorry, just real quick. How much, just step backing a little bit here, how much is your household spending a year, roughly, just to pay the bills?
Probably 60,000, 70,000.
Okay, and then you're both going to be obviously eligible for Social Security, correct?
Correct.
Yeah. I probably, before I'd go and look at anything like this, take a step back, write the plan that says, here are the income needs we have, here are the sources of income we have, look at it that way, and then see, well, we need to tack on some insurance here just to be sure that we're both going to be okay for a long period of time. And the reason I say that is most of these policies are sold, they're not purchased. Number two, Don's correct. Most people don't end up needing long-term care. Care at the end of your life turns out to be shorter than most people believe it is and less expensive in many ways. So I probably start with that and then work my way to the actual product.
Yeah, and the here's the thing, Robert. The devil, again, as I said, devil's in the details of these things. You read the disclosure documents, and you'll probably find that this policy requires that you spend down the annuity first.
Yep.
Before any benefit kicks in. And they are probably charging about 1% a year for the insurance, and then that will pay you this little tiny piddly amount every year or every month up to that maximum of $300,000 if you stay for a very long time. But it's probably not going to come very close to covering the realistic needs. Plus, there's no inflation protection. So there's no magic with these
Tom
things.
and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
There's when you get into your 50s or 60s and you haven't purchased a long-term care policy that's very expensive, by the time you get to your 60s, it really is pretty much too late to make
it's just going to be, and they're writing so few of the premium policies that what they really want is the hybrid where you give them a bunch of money. Yeah, exactly. Where then they figure out how to put the rider on it. So, I don't know.
They figured it out. They go, okay, let's see. Odds are if you go into a nursing home, you're going to be dead in 2 years. So you cover the first year out of your annuity, and if there's a second year, okay, we'll kick in for that. Yeah. But what is it? I came up with a great term for the insurance industry. Oh, it was so.
I'm sure. What did
I think? Oh, I'll have to remember it. I can't remember it. I came up with it the other day. I'm going to refer to the insurance industry as this from now on as soon as I remember the name. In the meantime, we're going to go to Tumwater, Washington. And John, you're up. Welcome to Talking Real Money.
Hello, gentlemen. I kind of talked to you last week, and then I got confused, so I wanted to call back because I'm helping out a friend with her deferred comp. And again, I'm looking at the equity exposure they have, right? There's a global equity fund, which is 60-40 U.S. international, a small cap value in emerging markets. And I'm trying to figure out how best to, how should that portfolio look for the equity side as far as the percentages of each? What would be reasonable?
So go back to that. So again, there's a large component in there somewhere, right? Too a U.S. large stock component.
Yeah, and this is where my confusion came from because the global equity fund has got all the U.S. large in it.
Okay.
So it seemed to me to have the global and the large. You're doubling up the large.
Yep, you are.
So in that case, then I would probably just go 80% in that and 20% in the small, because the global should include emerging markets. Didn't we have this discussion last week, or does it not?
We did, but it doesn't include the emerging markets. It does not. Different.
Okay, then in that case, I would do 70-20-10. I do 70% in that global fund that includes large U.S. and developed countries. I do 20% in the small and 10% in the emerging markets.
Okay,
that sounds good. Yeah,
awesome. Okay, all right, and then just one follow-up question. So. You prefer to have bonds in the tax-deferred portion and not in a Roth. But
that's correct.
If you wanted to ease to, for rebalancing, is it okay to have the same portfolio in sort of both so that you can rebalance easier? Or would you really try to work hard to keep the bonds in the tax-deferred portion?
I think you'll find opportunities to rebalance between the different types of accounts just by sticking with. I mean, you may not be able to do it as well as you could otherwise, but I think that becomes less important if for example, you're 5% short on the amount you're going to be putting into bonds because you don't have enough in that account. Then you pick it up elsewhere, or you pick it up through new contributions going forward.
So you're saying have the Roth 100% stock and then have the fixed income in the 401, 403B, et cetera.
In the 401, 403, and 457.
I think I'm in agreement there. Yeah, I mean, but it's just such an advantage
because let's say you're short, you just don't have enough of let's say the bonds. Then you just add to the bonds over. I'm sorry, you don't have enough bonds to cover the stocks. You add to the stocks through your contributions. You up your contribution to those to change your balance back to where it should be.
He's right. And again, what I was just mentioning, the fact that you could have all that in Roth and it hopefully would grow 10 to maybe even 12% a year, tax-free, huge advantage. It's under. People do not give it. People don't give it enough credit that they. And I heard Don talking about this on the podcast yesterday, about this aspect of really trying to build, especially for young people today, stock up those Roths when your tax rate is low. You were talking about this on the podcast, Don. Mm-hmm. It's absolutely right. Build that up. Maybe then when you get a little older and your tax rate's higher, then you start to do some of the stuff to reduce.
The pre-tax
qualified.
money.
Yeah, no, it's such an advantage. But you're a great friend, I got to say, John, to help out your friend with this investing.
Yeah, good work.
Thank you. I lean on you guys, and I hate to steer somebody wrong. If it's me giving advice, I just feel like I need a second opinion to make sure I'm not crazy. So thank you so much.
We like being the second opinion.
I don't like being leaned on. My legs have been sore from the swimming and boating and everything, so I don't like leaning.
Yeah, this time, though, if they lean on you won't fall into the lake. I remember what it was.
I could roll into it from here, though.
When we refer to the financial industry, we call it Wall Street. And I was trying to come up with a name for the insurance industry. Wizards of Odds.
That's good. That's really
Tom
good.
and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey there, our phone number is 855-935-8255. That's 855-935-TALK here on Talking Real Money, where we talk about money, really, on a radio show. I hear somebody shushing in the background. Must be your grandkids.
Yeah, they're getting ready for lunch, so looking pretty good, I got to say.
I saw those magic boxes in the background. What were they doing? They were like,
I don't know. They're two little boys. I was just talking to my daughter about this, saying, get over it. This is what they do. They go find stuff, they break stuff, they throw stuff. It's just, that's just the way it goes.
And they're boys. I mean, little and boys. That's a combo. So, that thing we were talking about earlier from FISYN, that
the raw land deal. Yeah.
Mm-hmm. Yeah. It is actually a great example of, although not a great example, a questionable example of what this thing that's been in the news lately called private equity.
Oh, yeah.
That is a private equity deal. It's a deal that
alternative.
You can get into, and he claims that it's not risky because the price never changes. Well, that's because it's private equity. The price doesn't change because there's no market for the stuff. You can't just look up on Zillow you can't even look up on Zillow what the land's worth.
Well, you can't get your money back tomorrow. That's the other thing. Yeah, I mean, any other security you should.
Now we have the President of the United States issuing an executive order saying that people who don't even know they're in annuities in their 403B plans can get into private equity. Oh,
well, it's worse than that, by the way. It's people, and no offense to anybody, I don't want to hurt anybody's feeling, but I talk to people on a regular basis that don't know the difference between a stock and a bond, which there's a decided difference between. They're very different types of securities.
There is no way these people should be allowed to put private equity in. There's no way. There's no reason anybody should. Private equity should be the purview of only the truly qualified investors out there.
Yeah, and we've seen meltdowns of private equity. But let's talk about you have to view them as higher risk because you can't trade them every day.
No, their price doesn't fluctuate, Tom.
Yeah, they have to be. You can't get liquidity. There's a higher cost involved because there's going to be more people between you and that security than there would be in a publicly traded security. Right? I mean, that's just the nature of the beast. It's, as you just said, you don't know what they're worth, and it's very difficult as an asset class, as a group of securities, to truly measure what the performance has been. Because you read one place it's this, you read another place it's this. I read somebody's making an index out of these things that's going to be available this fall. It's really hard to tell how they've done. But I can tell you this. There's been some spectacular meltdowns of this kind of thing. There's institutions that are currently trying to unload their investments in this stuff because, well, it hasn't worked out. And as you said, you don't know what it's worth. And you have to wait years and years to get your money back. So I always look at this from the perspective of you, the investor. Is this something you need or is this something you want? I want it because these other rich people do it, And I'm going to tell you, I don't think you need it. That would be the way I'd look at it.
Yeah, and these private equity deals don't just have to be like the real estate with FISYN. These can be almost anything. I mean, some of the biggest failed private equity deals were companies that were taken private.
Yep.
Like remember WeWork? You saw
Sure.
you saw the
I read the book.
documentaries and the books.
Read the book.
Yeah.
Sure, yeah.
I mean,
right, yeah.
These things are there for people who truly know what they're doing and understand that the returns can be great. The risks are dramatic. They're beyond. When we talk to audiences, we often say, how comfortable are you losing half of your money in a bad market?
And no one raises their hand.
These are 100% potential losers. 100% potential losers. And the expenses are high. They are not something that any individual investor should be in.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at talkingrealmoney.com or call 800-386-3004. That's talkingrealmoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And our phone number is 855-935-8255. That's 855-935-TALK. You can call us every Saturday, noon to 2 on Northwest News Radio with your really important money questions, no matter where you might be in North America. And let's go to the eastern side of North America, the northeastern side of North America, Albany, New York. Scott, welcome to the show.
Hello. Good afternoon. Thank you for taking.
Glad to do it. What's up?
I've got a question about a taxable brokerage account with my wife and I. And for a little context, we've got a 6-month emergency fund that's fully funded. We have money set aside for a new home in the potential not-so-distant future. And we feel like this would be, well, I feel like this would be a good place to park overflow cash from rolls. And also, I should also include that we also contribute 15 to 20% into our retirement savings. And the idea is to not put too much into the retirement savings to where we don't have enough at the end of the month. This is kind of just a little extra.
Okay, because when you say park, that always there's a temporary aspect of parking money. That means like I'm parking it there until you said you have a separate fund for the house.
You're not pouring a foundation around your money.
It's just like a kind of shifting. Is that what you're asking for?
Well, yeah, I guess let me put it. That might not have been the best way to put it, but the idea of investing money into a idea.
You're kind of cutting out, so we're missing syllables.
Yeah. So let's see. And we lost you there. But I guess the question for us would always be the reason that money's being saved. What's the purpose of it? Is it truly long term?
If you've got emergency money and you've got plenty of new home money and you're putting money into retirement, it sounds to me like this money, because you said I'm concerned about putting too much away for retirement and hurting our cash flow month to month. Yeah. But that really is the purpose, I think, of the emergency. You budget out for the month, and if things don't work out one month, you're a little short, you use the emergency money, and then you use that extra money that you have in the future when you have extra to replenish the emergency money.
I think that's spot on. Yeah. So in that case, then it would be federal money market or something like that in the brokerage account that's still paying, I think, somewhere around 4%, right? I don't think it's changed much.
And it sounds to me like maybe you need more than 6 months of emergency money. If you're worried about possibly running out of money in a given month because you're cutting it a little too close on your savings, then I think that means I need a bigger emergency fund. So I would add to the emergency fund, and then if you still have extra money every month, then that can go back into retirement. Again, shortfall down the road, use the emergency money to fill that gap and slow down the retirement money, refill the emergency fund.
Yeah, and then the other thing, still, Scott, is the other question, because when you mention the home purchase, those can often cost more than you think. There's all kinds of, so I'd probably be over saving for something like that, even especially if it's in the near term, because who knows, right deal comes along and you want to take advantage of it.
Yeah. Well, although if you up the emergency money, you could use some of that.
The money's there. Yeah.
Yeah. Go to a year on the emergency money. Just start adding that extra money to the emergency pool, and then I think I would use any money that you don't think you're going to spend in a month. That goes toward retirement, because that is going to be the biggest need
expense. Yeah.
That any of us ever have. Bigger than a house, bigger than a college education. Yeah. It's big.
And I think what he was asking is what fund to do it. Again, I'd use one of the federal money market funds. That's savings. Short-term money. But this is in a brokerage account. So
then, federal money market fund.
Yeah.
Yep. 855-935-TALK is our phone number. We've got lines open for you on a Saturday. And remember, every Saturday you can call us, noon to 2 Pacific time. You can also, though, go to talkingrealmoney.com and there's a button there that says Contact Us. And you click on that, and then you can speak questions, record them, your voice, and I use those on Fridays, or add them to Tom's big pile of paper.
Yeah, boy, is it pile. We got to get through some more of these. Thomas writes us from Spanaway. I understand by the podcast I listened to today that you would operate a total return strategy by reinvesting all dividends, then rebalancing, pulling out cash from the winners. That's right. Yeah, you would the things that went up the most. So that's pretty good. I'd like he wants his opinion on a variation which may have less capital gains. I'm using one of Paul Merriman's portfolios that are 4 funds: AVUS, AVUV, AVDS, and DFIV. Mm-hmm. My Roth is 100% equity. The IRAs are 65-35. I'm trying to get to the point here where he asks us about all the ETFs and one mutual funds in the taxable accounts are set to send dividends to cash. I generate $40,000 to $45,000 a year in dividends and capital gains. This does not cover all my spending goals, and I sell from winners when rebalancing for additional money required for my retirement needs. Currently, I am primarily spending from the taxable account my government pensions. I do not expect. I'm trying to understand what the variation here is. I guess the variation is he has the dividends plus then he takes cash from if he needs additional cash.
Yeah,
that's
but
okay.
Is there a question about a strategy that would
no,
avoid
that's the difference.
Gain?
What he's saying is he's turning on the dividends to pay himself regularly.
And that's fine. Yeah, draw the dividends first.
But just very carefully there. The longer term sustainability, if you will, of the portfolio has been allow the dividends to build up, then rebalance the portfolio at a certain time.
Yeah, but not once you're in withdrawal phase.
Yeah, the portfolio lasts longer because I've talked about this in my classes at retirement. So you're right. You could go either way, but the portfolio has been more sustainable to do it the total return method. I'll put it that way.
Okay, I'm having a math problem here. I'm having a math problem because the dividends, if they're reinvesting, you're still going if your needs exceed your dividends.
That's an interesting question because most people's needs are going to exceed their dividends because they're going to be 2% or so depending on your stock to bond ratio.
His needs exceed. I think this is a perfectly valid strategy.
I will send you the paper of which I rely on. I think it's from Swedrow et al. So
I'd love to see it because I'm having a hard time mathematically making this one work in my head, but I could be wrong. Let's see. So I got to do the math. I'm just going to have to sit down and do the hard math. 855-935-TALK is our phone number. That's 855-935-8255. Again, call us on Saturdays with your questions. We've got one. I'm just trying to do my back timing here very carefully. Let's start it with Pat. Let's just start.
Okay.
Hey, Pat, welcome to Talking Real Money. We'll start your question, and then we'll carry it over the break.
I have a question about QCDs. It's my understanding. That we are not allowed.
If you don't turn your radio off, it's going to be very confusing.
We're going to have speaking of understanding, it's going to be basically impossible.
I wanted to record. QCDs cannot be taken from 401ks and thrift savings plans, correct?
Qualified charitable distribution.
I'd have to go look at the rules, but I'm not sure.
Let me look it up, because and you hear the music, it works out. That's the way I can look it up and have the answer, but I'm pretty sure not. But I'm going to check. And remember, the number, 855-935-TALK, every Saturday, 855-935-8255.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I like making sure I'm right. Making sure I'm right. The IRS rule allows qualified charitable distributions only from IRAs.
Yeah, you can't do it from an employer plan of any type. So it's not just the thrift savings.
But you can transfer a rollover money from a 403 to an IRA and do it from there.
You simply move that money over. There's no taxation to that. The movie gets moved over. And what we're talking about here is a charitable distribution from your retirement account that reduces your taxes because you're no longer taking that as income.
Right. Does that answer your question?
That answers that confirms what I believe.
Yeah.
Now, my real question is, who made that rule? Who's in charge of regulating that rule?
Congress.
So, because I see in the newspaper they're making changes now about what retirement plans can be invested in.
Yeah.
Yeah, this would not include that.
Executive order. Yeah, that was done by executive order.
Yeah.
And here's what's going to happen, as with so many executive orders. My guess is somebody's going to challenge that in court. Really, when it comes down to, if you want rules like this changed, it has to come from Congress, and then it goes to the IRS, and then they write the rule. But Congress sets it up. So, Pat, thank you so much. We appreciate the call, and we're going to have to run because we're running.
I do want to thank our friend Paul Merriman for finally posting a recording that you and I did a long time ago called 10 Myths, Lies, and Mistakes That Cost Investors Millions. That's a podcast. It's available at paulmerriman.com. You just go there and click on podcast.
Why did you go up with your voice at the end like it was
millions?
Cost you millions?
It's been popular.
Could not be millions. Could be less
10
than
myths, lies, and mistakes. Paul wanted 100, by the way. We only did 10 because we don't work as hard as he does. So that's available, paulmerriman.com, and you click on podcast, and it's right there. So I think you might learn something from it. It's been popular.
Oh, yeah. No, I listened. It was okay. It was okay. It was okay.
I liked it, but it was a long time ago.
Paul put it up as a episode of Sound Investing.
Yeah,
but it's branded as Talking Real Money over it.
Yeah, people are listening to it anyway. Apparently liking it. So thank you, Paul, for that. Enjoy.
Yeah. And so go check that out. And check out all our podcasts at talkingrealmoney.com or on your favorite podcast service, which, by the way, favorite is right. Yeah, we are like on Apple Podcasts, we were the number 57 investing podcast.
Which might not sound much to you while you're listening, but go see how many investing podcasts there are. There's thousands and thousands. Yeah. So thank you for doing that for us.
And I just did the math, and we're in like the top 0.7% of all podcasts.
Almost to the top 0.5 of 1%. I knew I'd get to be a 1%er at some point. I just didn't know how long.
That's the only thing you're a 1%er in.
Okay, I'm okay with that. So.
And if you want to ask us questions, not during the show, when you can call 855-935-TALK, go to talkingrealmoney.com, click the Contact Us button, and then either type your question out or speak it through your microphone on your phone or computer, and we'll answer those on future shows or podcasts. And if you want bigger help, Tom,
you can always go to talkingrealmoney.com, click on Contact Us, and ask us for help.
No.
Ask an advisor.
Meet
an advisor. He's not going to help me here. So if you want some personal one-on-one help, and we did this for many people, many. take advantage of that.
I wanted to see if you remembered, and you didn't.
Don't. It's somewhere back in the lake somewhere. Minus, you know what.
TalkingRealMoney.com.
So
click on Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.